This conference will now be recorded.
Good afternoon, everyone. This is Kathy Neifeld with AgencyONE, and it is Monday, May 4th, and this is the beginning of our weekly WebEx series for this week. And this week we're going to be dealing with opportunities and products in the linked benefit arena, and we are thrilled to be kicking this week off with our friends from Nationwide. We're featuring Shawn Britt, who is the Director of Long-Term Care at Nationwide, and we are thrilled that Shawn has agreed to join us for this presentation, along with Jake Lovell, who is our Regional Long-Term Care Specialist. The session is going to be moderated by Ed Stark in our office, so if you have any questions, please remember to type them into the chat box, and we will get to them at the end of the presentation. But for now, I'm going to turn this over to Ed, and he's going to bring you Shawn and Jake. So with that, Ed, please take it away.
All right, thanks, Kathy. First of all, I'd like to thank Shawn, Jake, and William for being on the call from Nationwide. We really appreciate you taking the time to give us a kind of overview of what's going on. And I want to thank all the people that are attending the call, just to make sure you guys know we appreciate you guys also taking the time to listen in. So without further ado, let's start off with you, Shawn. Go ahead.
Thank you, Ed, and thank you all for joining us today. What we're talking about today is doing business in a COVID-19 environment. And we know that can be challenging, but I'm hoping after this presentation, you'll find some openings to do business with clients, because this is actually a good time to do long-term care planning, especially with linked benefit products. That's because it's particularly easy to sell and place and plan for long-term care in a COVID environment due to the fact that these products have always been set up with simplified underwriting. Little did we know 6.5 years ago, when we first introduced CareMatters to the market, that our underwriting process would fit in with a pandemic. But it does very well. So first of all, you can talk to your clients about a long-term care plan totally over the phone. They don't even have to come and see you. And you can do the application over the telephone. They can give you the answers to the questions. You fill it in. And then after that, you submit it, your client is not going to have to see a doctor. There's no paramed exam. There's no blood draw. There's no fluids. And in fact, the rest of the underwriting will be done by a telephone interview with your client. And they're going to sign their applications by smartphone or computer. So they literally can do this long-term care planning from the comfort of their own home and never have to see a human being and feel unsafe about going through the process. So this really is a good time to do long-term care planning. And another reason for that is that, a lot of the products out there, including Nationwide, offer cash indemnity benefits. These are particularly attractive benefits during a pandemic type of situation because you literally can pivot your care plan on a dime. So for example, maybe mom is getting home health care from home, but to do that, she has a couple of shifts coming per day, and maybe she's seeing 5 or 6 different people during the week. Her daughter isn't comfortable with that and wishes that she could limit it to 1 or 2. So the daughter decides to work from her mother's house, maybe cuts her work hours back 30% so she can devote time to her mother. In the meantime, all they've had to do is cancel the home health service for a couple of weeks while maybe it's a flu epidemic. And, every so often communities have to shut down schools and that type of thing. So they literally don't expose mom to healthcare workers for a couple of weeks. The daughter can be paid by her mother because she does have a 30% cut in pay to take care of mom. And nobody had to call the insurance company to do this. No permission was needed, nothing. So this is why cash indemnity can be particularly useful during such difficult situations, whether it's a pandemic or just a regular situation. you can pivot your plans on a dime, and that makes it very useful. So how can you fund a linked benefit policy? Well, that's what we're going to talk about next. And, when we think about retirement, what is the biggest asset that people have? It's usually their qualified dollars. Now, you can buy a linked benefit policy with anything. You could use transfer an asset from a non-qualified account. You could do a multi-pay from income, or you could do a single, you can do whatever you want. But what I'm going to show you today is how to protect the retirement plan. And that's really important right now when a lot of people's retirement assets are down right now. We want to make sure that they have long-term care covered in such a way that will never be subject to market risk. So once they make that first premium payment, their long-term care benefits are guaranteed. They're in place, they're not tied to the market, and they now have a dedicated stream of income, pre-leveraged, ready to go at a moment's notice if a long-term care need were to arise, so that they don't have to take dollars out of a down account at such a time if long-term care need were to coincide with a downturn in the market. But we also want to make sure that if we're using qualified assets, we're going to be able to do some tax management. So our idea for funding today, and again, you can fund linked benefit policies in numerous ways. This is just one way to do it. But if you have a client that has a lot of qualified assets and they're 59 and a half or older, you can use a portion of their qualified funds to plan a long-term care strategy and maybe do some tax management, because right now taxes are about as low as they're ever going to be. So we're going to create a distribution for multi-pay premiums that are going to purchase a CareMatters linked benefit long-term care policy. So what we're going to do is carve out a small part of that qualified asset, and in this case, it's $100,000. The $100,000 is going to purchase an IRA FIA, meaning a single premium immediate annuity. If you have the qualified assets in a 401k, you're going to roll them over first into the IRA. If they're already in the IRA, then you're set to go. But remember, if it's 401k dollars, first do a transfer to an IRA. Then that IRA FIA is going to fund the policy. And we're going to do it by setting up term certain distributions. And we're going to do it as a 10-year term certain distribution. By doing so, we've generated $11,015 a year. Now, if your client is willing to pay tax out of pocket, they'll get the most bang for their buck. So some people do that. They figure a little tax out of pocket is fine. Others want to use the after-tax amount, and that's fine too. But you decide which one you're going to use. In this case, my example, the client has agreed to pay tax out of pocket. They're going to purchase their guaranteed CareMatters long-term care linked benefit policy using the 10-year guaranteed premium schedule. Their LTC benefits are for 6 years. You can choose whatever benefit period you want, but I just chose the 6-year benefit period in this particular situation. So that was going to buy $417,000 of LTC benefits. And if they never need long-term care, there would be $139,000 of death benefit, tax-free to the beneficiary. If they do need long-term care, then there's a benefit pool of $417,000 to draw from. It's not tied to the market, that they're going to be able to use no matter when the long-term care event occurs. Now, I did not put inflation into this example, but you can easily choose to do an inflation plan if you wish. But with this plan, it would be $5,800 a month for 6 years, or nearly $70,000 a year to help pay for long-term care. So what have we accomplished with this strategy? Well, first, we've protected the portfolio from depletion, and we've ensured the portfolio does not have to be used when the market is down, because we have taken that with this policy, we've set up a dedicated stream of income off to the side, ready to go, and it's not tied to the market. And those benefits are guaranteed to be what you have purchased. Next, we've done tax management because the tax is paid on the distribution. So the tax was already paid. And the distributions are now leveraged into tax-free LTC benefits. If the LTC benefits are not needed, the beneficiaries are going to receive that tax-free benefit, which will always be at least equal to or more than the premiums paid. But what if death were to occur midway through the premium payment schedule? Well, not only would the death benefit be paid, but any remaining term certain annuity payments would also be paid to the beneficiary. Now, keep in mind that the death benefit will be paid tax-free to the beneficiaries, but any of the remaining term certain payments will be subject to tax on the gain to the beneficiaries. Now, I'm going to turn this over to Jake because, we're going to turn this over to Jake. Now he's going to show you how you can process the payment schedule for this idea.
Thanks, Shawn. Really appreciate it. And thanks, everybody, for your time on the call today. As Shawn had mentioned, what we're going to do is walk through some different ways and some different processes and how this works. So there's a couple of different ways that we can go about this process. I mean, if Shawn, we could turn it back to you so we can walk through each part of the slide. I think we'll be...
Yeah, Lisa, can we go back to the presentation for a second? Back to Shawn's screen. Hey, Lisa?
I'm doing it, okay?
Okay, sure. Sorry about that, everybody.
As we're pulling that presentation back up on
I think you should be able to
now
see
we're
it
able
now.
to now we're able to
Okay.
see it. We can talk through a couple of different things to consider as we walk through this process. And as Shawn had mentioned, a couple of important and key things to keep in mind is if we're using 401k funds to accomplish this strategy, we first want to make sure that we roll those into an IRA. Now, if the funds are already in that IRA, we're a step ahead, and we use those IRA funds to purchase that IRA single premium immediate annuity, or that SPIA, that's going to generate, in our example, that 10-year term certain distribution, so the 10-year payout that's going to fund the SPIA into the CareMatters product. Now, there's two different ways that we can go about accomplishing. There's one way, which is the gross method, and then there's the second way, which is the net method of paying the premium. So when we're utilizing the gross method, this must be accomplished by using the nationwide IRA SPIA. And as Shawn had mentioned, if we're going to go ahead and pay those SPIA payments through the gross method to maximize the leverage that we get on our long-term care benefit, that individual will then pay that tax on the distribution out of pocket, so they'll get that 1099 each year for 10 years to really get the max leverage for the CareMatters policy. The nice thing about the way that the gross method works is we can do this all internally, to where this gives Nationwide the opportunity to take that SPIA payment each year for 10 years, essentially walk that check down the hall from our annuity department to our life insurance department to pay those each year. It's the most seamless because nobody ever has to worry about paying those each year for the 10 years. It's all done as a seamless process by Nationwide. Now, the second option to consider is the option as for the net method of paying the premiums. Now, with the net method, we do have the availability to withhold the tax on the SPIA distribution The other thing to mention with the way the net method works is you could essentially use any SPIA to accomplish this. However, when we're utilizing the net method and we're withholding those taxes, regardless, you still have to have those funds distributed electronically into some type of either checking or savings account where that client is taking ownership of those funds. And then what we would do is we would utilize the EFT out of that same exact account to pay the CareMatters premiums. So those are a couple of different things to consider, and the way that we're able to accomplish this, and a couple of different processes to walk through, and just some things to be aware of. Now I'm going to turn it back to Shawn so she can finish out the presentation, and then at the end, we're going to turn it back over to myself. I'm going to walk through a little bit with the underwriting process as well.
Okay, Jake, thank you. And I want Jake to have time for his underwriting process. So basically, just to make sure you all know, you do not have to use qualified money to do this. Non-qualified money works as well. You can actually buy a non-qualified SPIA and do the exact same thing we just walked through with non-qualified money. Maybe you have an annuity. Your client isn't going to need a non-qualified annuity. You can set it up the same way with the term certain payments, go through the same process that Jake just talked about. But think about CDs that are maturing. Use those as a single premium. A recent inheritance, that's how I bought I own the first CareMatters policy, and that's exactly how I bought it, with an inheritance. Bonds that are maturing or being called. You can see from the list here, there's a ton of opportunities. A low-yielding asset that's kind of been an emotional hang-on to for a client, maybe you can talk them into getting rid of that low-yielding asset and do something much better where they're getting that immediate leverage. And, we already talked about cash indemnity benefits, but I do want to, this is the key definition of cash indemnity. No restrictions from Nationwide on how you use the benefits. So that means whatever it is you want to do, whether it's a typical long-term care service or something very atypical and very creative and totally outside of the box, you're able to use those benefits for that type of care or whatever it is you want, because Nationwide will never place any restrictions on how the money is used. That is what cash indemnity is. So I'm going to turn it back over to Jake to go ahead and finish the underwriting part.
Thank you, Shawn, so much. And if we're going to go ahead and we're going to turn the controls over to me so I can show a couple things on my screen on exactly how our underwriting process works with CareMatters 2. We talk a lot about the need for long-term care, how important it is, and then the different solutions to consider. And as we look at the situation that we're in right now, especially in a COVID environment, it's important to also consider the process for the different solutions that we're talking about and considering as well. So what we have is we have a nice piece here on the screen so everybody can get a feel of how our underwriting process is set up and how this works. Since this is really set up, as Shawn had mentioned at the beginning of the call, to really help with the current environment that we're in. So this is a process that can be completed from beginning of the application all the way to the end of the underwriting process without ever having to worry about any type of in-person interaction. So a couple of things just as we walk through here. Step one would be the application, submission of the application, which we do have the availability to complete electronically. Now, once that's sent over to Nationwide, what we do is our underwriting process is essentially a telephone interview. It's usually about an hour long with the client. And this telephone interview can be completed in the comfort of that individual's own home. So again, they don't have to worry about going to see a doctor. Generally, we're not asking for any attending physician statements, not that that would require them to see anybody either. But the fact that this is an underwriting process that's completed as a phone interview in the comfort of that client's own home, and really this can be completed as quick as or as little as 6 days, and depending on when and how available that client is able to get that phone interview completed. And then it's a matter of us reviewing the underwriting and then getting a decision out for that process. So we have a lot of information in this piece. We'll make sure it gets out to the group. Some other things to consider. We take pride in pre-screening all of our questions around any of your applicants that you may have. We have direct access to all of our underwriters, whether it's via email or phone call. We certainly encourage all of you to utilize the pre-screen process. And then the second part of this document goes through some conditions and some medications that you would want to make sure you would be able to move forward with that application. So again, just in the current environment, this is a process that's really conducive to being able to complete this from start to finish without ever having to worry about any human interaction. And then we encourage everybody to make sure that they're pre-screening, that they have access to all that information as well. So I know we're getting a little short on time. We wanted to make sure everybody was familiar with some different sales concepts, some different ways to fund and strategies to consider when purchasing and paying for the plan, as well as the underwriting process and the whole process that's set up for this. So with that being said, I'm going to turn it over to Ed to make sure we're able to have some time for any questions that we may have along the way. Ed, are you there?
Yep, I am. Thanks, Jake. Thanks, Shawn. So yeah, if you guys have any questions, please put them in the text box there on the top right. But we do have one question, and I think it pertains to the product. So the product question is, I guess it also depends on the funding strategy, but what's the typical cash value in year one? Does this product have the return of premium feature that kicks in right away, or does it sort of take a little bit of time for that to come back?
Well, first of all, we have 3 refund of premium features. So it depends which one you choose. If you do a single pay or a 5 pay, then the full refund of premium is available day 1 of year 6. So it's a 5-year vesting schedule where you would start at 85%, and each year more would become available until the end of the 5th year when you're up to 100%. But then we have a level where it's 80% for 10 years, and then we have a minimum refund, maximum LTC benefits. So by just going by the surrender schedule, you'll get the most LTC benefits. If you do a 10-year schedule and you want that maximum refund, then day 1 of year 11, you would be able to get all of your money back. But again, that'll be the least. So the more attractive your refund to premium is, then you get a little less LTC benefits. Jake, is it 83, 87% are doing the maximum LTC benefits? I know it's in the 80s, but I forget the exact percentage. But the majority of our clients are opting for the maximum benefits because they know they're not going to need the money. The other thing to keep in mind is most people who want to cancel the policy actually do it in the 30-day free look period. And that's just like an annulment. It never happens. So they get all of their money back. So hopefully that answers your question.
Yeah, no, that's an interesting stat. I mean, from a design point, we typically always, defer the ROP out because it does make the benefit look that much better. So, I mean, I agree with you on that. Another question we have is who does the questioning? So they're saying that when they speak to the clients, an hour seems to be very long to keep someone engaged. Are they licensed?
The person it's an underwriter. I can actually speak to this. As I said, I own the first policy ever written. I helped design it, and I wanted to be number 1, and I was. So I've actually gone through the process. Actually, they keep you very well engaged, and the way they do that is they're gonna start by making you a little comfortable, asking you some questions, and then they start with the cognitive screening, and they're going to ask you questions where you have to think, and then they stop and they go back to some more medical questions, and then they go back to the cognitive screening where you have to think. So it's very easy to stay engaged with the way they shift the questioning around. And then, of course, we tell you to plan for an hour, but if you don't need to do the cognitive screening, we've had interviews that are 20 minutes. I mean, it literally depends on the client and what the underwriter thinks they need to do. But that's why we say tell your client to plan for an hour. It doesn't mean it will take an hour, but they need to plan for an hour, if that helps. Okay. But yeah, it keeps staying engaged. I couldn't believe how fast that hour went. It went by like that, honestly.
Okay. All right, great. And then staying on the underwriting, another question is how many cases, and this can be a ballpark number, do you think are issued without APSs being ordered versus the no APS being requested? Do you guys have any metrics on that?
Jake, you probably know that better than I do. I'll let you answer that.
Yeah, so I would have to check to put a number on it. What I can speak to with that is there is a tendency to see more APSs ordered on the California interview because of the way that interview is conducted. So we do have some different things to consider from the way the California product is set up and positioned, the way that interview process works. We would have to check to put a number on that. So I would have to check on that.
Yeah, what Jake's alluding to with California is that regulation does not allow the interviewer to drill down. So if you answer yes to something, they can't ask for details. That's the reason so it's not a nationwide mandate. It's actually a regulatory challenge that we have to overcome by asking for the APS. That's the reason why there's more in California. The other thing to consider is the APS is actually the underwriter's way of saying there's something a little off here and we don't want to say no, but if we had a little more to look at, we may be able to say yes. So don't look at the APS as bad. Look at it as the underwriter's trying to get this issued.
Okay. All right. No, great. And keeping along lines, I guess one other question, is this a New York product as well? So can this be written in New York?
Yes, but it's a New York specific product. So it works slightly differently than the CareMatters 2. It's relatively the same. I mean, for all intents and purposes, but there's a few, probably the major difference is that New York will not let us change how much benefits you get, whether you pay a single pay, a 5-pay, or a 10-pay, which is the only options they have in New York. There's no pay to 65 or pay to 100 in New York. So whether you do a single pay, a 5-pay, or a 10-pay, we have to give them the same exact benefit. So in New York, we totally promote using the SPIA plan, because why would you do a single pay when you don't get any more for it? You might as well put it in a SPIA and let the interest buy you. You get about 10% more coverage if you'll use the SPIA plan. And as I said earlier, it doesn't have to be qualified. It can be a non-qualified SPIA as well. So anyway, for the New York cases, I highly recommend that you use the SPIA concept just to get the client a little more coverage for their dollar, if that makes sense. If you need to dig down a little deeper, we can, Jake can talk to you offline about that.
Okay. Oh, great. Thank you. And then I guess for both New York and other states, what's the max issue age available?
Do you want to take that, Jake?
Yeah, so the max issue age is going to be age 69 for those products.
At least for now, because of COVID. You'll see our literature will show up to age 75, but we've had to make that change due to COVID. Sure. So we don't know whether it's temporary or permanent right now, but it is right now through age 69.
Okay, great. And just to finish up with one last question. So one of the agents is mentioning that back in the day, LTC, you could actually differentiate it by saying cash, indemnity, and then there was a reimbursement option. And now everyone seems to be saying that cash, it's cash and indemnity, and then there's reimbursement. Was it incorrect to say that there was a difference between cash and indemnity, or is it just kind of what people using it the same way?
No, I'm impressed he knows there's a difference. I mean, most people don't know that. So whoever asked the question, I'm giving you a high five. Most people believe cash and indemnity are the same thing, and they aren't at all. So all indemnity means is whatever your benefit is you signed up for is how much the check is going to be. That's all it means, nothing more. But the insurance company that's selling just a plain vanilla indemnity product can still ask for a proof of a billable service. They're not going to change your benefit amount. You can just send one in. They want to make sure you're following their rules. So they'll ask for proof that you're following the rules. They don't care how much the bill is for, but if they want to make sure you're using licensed providers, then you've got to send a bill from at least one of your licensed providers to prove that you're doing so. So that's what a vanilla indemnity can still have strings attached. Cash indemnity literally means no bills, no receipts, no proof of a billable service, no anything. You're literally, once you qualify for your claim, you're getting cash, and there's absolutely no restrictions on how the benefits are used. Vanilla indemnity can still put some restrictions on it. They can say this money has to be used for qualified long-term care services. They can say you have to use a licensed provider for those services, where cash has no restrictions whatsoever. So cash will allow you to use a family member 100%. We actually had a true case where the client wanted to know if she could use her cash benefit if she ever needed care to have someone take her on a plane to Tibet for the Dalai Lama to pray over her. Now, I don't think she really intended to do that. I think she was actually a very smart client. When they said cash, she wanted to be sure it was cash, so she cooked up the craziest story she could to test what cash means. And my answer to her was yes, as long as you qualify for claim, you can go to Tibet with the money. So anyway, that's the difference between indemnity and cash indemnity. Cash means no restrictions.
All right, great. Well, thank you very much for that. Again, I think we're at our time. So it looks like everything worked out well. Kathy, do you want to close this out for us?
Sure. Thank you, Ed. Shawn and Jake, thank you very much for this presentation. I hope that the advisors on the phone found value in it. We work with a number of advisors that continue to call me and say, if all the advisors at AgencyONE are not selling this nationwide product, especially now, then I need to understand what they are selling. So you've got a number of fans within the AgencyONE family already, and I hope that this presentation converted some others and opened up some other eyes as well. We are going to continue the Linked Benefit Week on Wednesday, May 6th, again at 12 o'clock, featuring Securian and some interesting product opportunities and sales opportunities using the Secure Care Universal Life product. So I hope all of you will dial in again on Wednesday at 12 noon. If you've got any questions regarding the presentation you just heard, need additional information regarding Nationwide, or if AgencyONE can help you in any other way, please feel free to reach out to your team. We are here to help you today and every day. I hope everybody stays safe and healthy, and we look forward to presenting again on Wednesday. Thanks, everybody. Take care.
Thank you, everybody.
Thank you.